effective financial management for nonprofits. Are you achieving your goals and getting the desired results? It's an opportunity to review how your nonprofit handles its overall financial management operations. I started a nonprofit myself 25 years ago. It's called Hands for Hope LA in North Hollywood and Van Nuys. The consulting company came about because people kept asking, well, how do you start a nonprofit? And then so I thought about sharing the knowledge that I have because I've walked a mile in the shoes of the most nonprofit leaders. I'm available as a coach, a consultant for everyone after this call. Feel free to contact me if you have any questions or any help that you need. I have a degree in accounting and a master's in organizational leadership. No matter how you're set up, you should have a board. They are ultimately accountable for everything that you do, and all the finances in the organization is their responsibility. They have to help you develop a budget, and they have to approve that budget. And if they can monitor your budget and make sure that it's clear, that it's intelligible, that's accurate, that it's timely, that you're giving the financial reports to them on a regular basis. They say 73% of nonprofit EDs say financial reporting is their biggest source of stress. And why? Because sometimes the reports are late, they're inaccurate, they're confusing, and that makes the board not want to be a board member maybe because they are responsible ultimately for your organization. So keeping that in mind, why should we do effective financial management? If you're the leader of the organization, you need to have the answers. When you're asked about your organization's financial health by your board, by your funders, by your donors, at a moment's notice, you can tell them our budget is 500,000, our budget is 800,000. And you want to know the difference between what your budget is and what is actually happening. And hopefully that's not a large difference if you did your budgeting correctly. You need to know if you're able to hire or purchase things. So you need some peace of mind. And that comes with knowing that your organization is sustainable. And the reports that you get paint a picture for you of how your organization's doing. And that picture is being painted by you and your bookkeeping staff, your finance staff. So that picture goes out to the funders. They get to look at that picture. And sometimes it tells them, I don't want to get involved with this organization, or it tells them, this organization is financially stable, sustainable, we're going to support it. So you need to know that that picture is correct to get your records correct. You may need to also have an accountant or a CPA, and that person can work with that bookkeeper to oversee their work. The CPAs don't normally do your bookkeeping, and the bookkeeper doesn't normally do your taxes. And you can get someone that's working with you. If they're not a full charge bookkeeper, they can become a full charge bookkeeper by being trained. In leadership, we're encouraged to involve the staff in decision making, but bookkeeping is more of a solitary area where the information is secure and not shared or discussed. What internal controls means is that maybe the same person that writes the check does not sign the checks, because you should be separating those two tasks. Sometimes you're a small agency with just a few staff or just an executive director and one other person, but you're working towards having internal controls in place. So it shouldn't be two family members performing those functions. It just looks suspicious to the outside world to have two people too closely connected managing all aspects of the finances. And there's a concern about purchases from family or from board member. The accounting profession has seen all sorts of crime. So they have come up with some fail-safes to prevent situations that would be fertile ground for criminal activity like theft or overpayment. So there's going to be some internal controls, define the roles of these people. The bookkeeper, this is the person that keeps track of your day-to-day financial transactions, such as your purchases, your sales, your donations, your receipts and payments. If you have assets, expenses, any income, there needs to be someone who understands accounting, debits and credits. A controller, that title's not used so much anymore. Really, it's combined now with the CFO, but this is the person that's controlling the accounting department and putting in place those internal controls we talked about, and deciding on budgets with the board and spending and other financial commitments. As a business approaches fundraising or starts to receive revenue, it's time to consult a controller, CFO type person, or a bookkeeper that has the knowledge and the skills that you need. CFOs or chief financial officers are the planners and the communicators and the consultants and the leaders of their companies' financial strategies. And whether you're gearing up for an IPO or in the early stages of growth and looking for advice, a CFO can assist with investments, help work through initial cash projections, advise on corporate governance and ownership structure. There's no ownership in a nonprofit, but the people at the the top level, they can get some advice from the CFO. The person who's a CFO is just above the bookkeeper and someone with a little bit more capability and knowledge. Small nonprofits don't have room for or finances to pay a CFO. So you might have a bookkeeper that is a combination CFO bookkeeper, or you might have a bookkeeper that's all they are, and you're relying upon a board member who's a treasurer to assist with some of these decisions and some of these tasks that I mentioned. And then you have a CPA who's an accountant, and they've gone to school and are certified to prepare tax returns. You don't pay tax as a nonprofit, but you do have returns that you have to file. You need someone who's certified to do that. You could fill out a postcard if you're under a $50,000 budget, or you could even try to do the return yourself. But these people are certified and have to do training regularly in order to be able to stay on top of the new rules and the new things that come up. So you can't really take on the role of a CPA. That's a separate function that you may need a person to function in that capacity. Then there's accounting terms that you may need to know as it relates to you and what you're doing. Like GAAP, an accountant may say that to you. It's generally accepted accounting principles. These are guidelines that these accountants have to follow. Accruals, if you incur a debt, you would record it in your bookkeeping then, not just when you pay the bill. Accrual is a term that is used by accountants. You can be a cash basis or you can be on an accrual basis. Double entry bookkeeping means that you're recording it twice. You're recording the income when they tell you you're going to earn it, and then you're recording it again when you get paid for it. So that's dual entry bookkeeping. And if you're on a low budget and can't afford a bookkeeper that spends a lot of time, then you really want to be on a cash basis so that they're not recording things twice, because that takes extra time and you have to pay them more. Now, some nonprofits, like the one that I run, we're accrual at the end of the year. Throughout the year, we don't do dual entry bookkeeping, but at the end of the year, we might record a receivable that we know is coming in related to something they promised us in November or December. We're on a calendar year, and some people are on a fiscal year, which is different times throughout the year, but calendar year is what most nonprofits and businesses are on. So that accrual scenario, you have to tell the IRS which one you want to be. We're on a cash basis, we're on accrual basis. If you're going to do that at the end of the year, that you do have this money coming in, that you don't want to show a deficit because you know you have this money coming in the next month or so, then you would be on an accrual basis, and you can do that at the end of the year. Once you tell the IRS that's what we're going to be is accrual, and we're going to record that on our 990 form. So it's going to increase your debit expense or your assets, increase your credit liability. Those are what you do when you're on an accrual basis. You're going to increase your receivables and you're going to increase your liabilities. That double entry scenario the second entry is when you pay it. So I know this is a little complicated for some, but it's something that I do think you need to be aware of if you're in leadership at a nonprofit. Which basis are you recording your information on? If you have a bookkeeper that's just decided that you're double entry, then they're recording every bill you see. If they're not on dual entry, they're just recording it when you pay it. The general ledger is a list of all your bookkeeping transactions. So if you have accounting software, the general ledger is something that you're going to have that's going to list everything that happened, just like a record. So if you wanted to go back and look at the activity, that's a good report for the bookkeeper to run for you. And you could request it for a period of time. I want to see this month's general ledger. So your bookkeeper will be shocked and surprised if you're asking for that, because they're going to know that you're checking on what they're doing. And you'll know now that you're able to talk to the bookkeeper about and speak their language. The 990 form, it's required of nonprofits, and all entities have to report to the government. We don't pay tax, but we report. And nonprofit reports, that 990 has grown in size. It went from 6 pages to 25 pages. There's things that the accountants, the CPAs know that they now ask for that they didn't ask before. And some of those things are a reaction to crime that was happening. They've come up with different ways to catch things. I really recommend you take a closer look at yours so you can see what's being said about you. Trial balance, it's showing you debits versus credits, which always have to equal. The debit side and the credit side. It's always got to have both. You never have just one. And the trial balance shows you that those two sides are balanced within your accounting system. And then full audits sometimes are required by funders. They're requiring it a lot less these days because it's very expensive to get a full audit of your bookkeeping. When they do a full audit, they're going to come in almost like investigators, and they're going to come in and go through everything when they do a full audit to see how you're doing things. And they're going to be looking at those internal controls, and they're going to be giving you a score or grade. Or to pay that much money to have a full audit, you really want to know that your books are in order before you pay that money for an audit. Because once you have it and they give you that report and it says they failed, you don't want to give that report to anyone. So now you've done a full audit just for your information. It's not a bad thing to do, because you'll have the information about what things you need to do to correct yourselves. But that full audit you want to try to get ready for. And a good bookkeeper knows what they need to do for that, but the accountant is much more familiar what needs to be in place before you have a full audit. And then there's something that's a lesser version of that called an audit review. An audit review is a lesser version. They do some spot checking instead of checking every single thing. And they write what they call footnotes and opinions, and their opinions are valuable. You want those opinions to be positive. You want a good score. So this 990 form, it is public. You can go to GuideStar and look at anyone's 990 if they're a nonprofit. So whatever goes on here, if it shows that you had a deficit or that you were not, your assets were in the negative, everyone can see that if they choose to. I could go right now to any of yours and look at your 990s. Everything about you that you file in here is public information. And you are a public entity, so everyone has the right to see it. You want to have an accountant who is ready to get that information from you and put it on this report. And you may want to take a look at what the CPA is doing, because he may not know something about you that you know to put in here. He may not have the correct mission statement to put in there. They do ask that as well. So you want to make sure that you're working closely with him when you're doing this report, so that it comes out for the public the way you want it to come out for the public to see. When I speak to clients, I ask that they have these particular documents prepared monthly for their board to see. But these other reports that we have here are reports that I believe that you should be looking at monthly. I had a client who said, well, I only give the board the balance sheet, or I give them only the income statement. That really does not give them all the information about your organization. And then the cash flow projections, they should be working with you on that and looking at that and seeing down the road, we're not going to have enough funds. The financial documents for every nonprofit, that you want these to be available to show a picture of your organization. They show your nonprofit's financial health and stability. If the thought fills you with dread, don't despair. Even if you have a limited financial background, you can learn the basics. You need to kind of learn to see these reports and read them and understand what they are. And we're going to go through them. And being informed will help you make sure your organization's financial management is in good hands. So the statement of financial position is the first one. And the other name for it, you'll hear people call it a balance sheet. Debits equal credits, assets and minus liabilities equals net assets. So that's the document that's going to show you your assets, your receivables, your cash in the bank, equipment that you have. Those are assets. And then you have liabilities. Who do you owe? The balance sheet, it provides a snapshot of your organization's finances. It lists assets in order of liquidity, the speed at which they can be converted to cash, and liabilities in order of the length of obligation, long-term versus short-term liabilities, things that you don't have to pay, loans you took out that you don't have to pay back for 2 or 3 years, or short-term loans, things that are due in the next month. They're conventionally prepared at the end of the fiscal year, although larger organizations or those with extensive financial changes might choose to prepare it quarterly or monthly. I highly recommend monthly having this report so that you're able to act on things that you see in it. All of these reports you should be getting monthly. Whether you give them to the board monthly or not is a different story, but getting them monthly is something you should be looking at so that you're not surprised when you get them quarterly or at the end of the year. And if your bookkeeper's not giving them to you, they know how, they can, and you need to ask for it. And so assets includes cash and cash equivalents such as gift cards, certificates, grants receivable, depreciable furnishings and equipment. Liabilities includes accounts payable, grants due to other organizations, or debts. Your net assets are those remaining assets after you've subtracted the liabilities. And that's the accounting equation. Assets equal liabilities plus net assets, or assets minus liabilities equals net assets. And that demonstrates that your organization has enough cash or cash equivalents on hand to equal your outstanding debts. So you want to make sure that your balance sheet is balanced. A negative cash balance would not look good. And these are documents that are going to be public at year end. They're taking this same information on the 990 form on the very bottom. They have your assets listed there and your liabilities. It doesn't look like a statement or a report that you're used to seeing, but they're taking the numbers from that and putting it on the bottom of the 990 form. So the statement of activities shows how your net assets are changing over time. They're a snapshot of just this 1 year. It increases as revenue comes in and it decreases as expenses are paid. It's the nonprofit equivalent of a for-profit income statement or profit and loss. And it's your revenue minus your expenses equals your change in net assets. So the statement of activities distinguishes between unrestricted, temporarily restricted, and permanently restricted activities. So if revenue comes in within 1 year, fiscal or calendar or other specified period, but with a restriction that prevents it from being used immediately, that income is designated as temporarily restricted. If a donor makes an endowment or some other financial gift that can never be applied to programs, it would be designated as permanently restricted. However, the income earned from an endowment in the form of interest does get reported again with appropriate restrictions. What that means is you can spend the interest. You can take the money that people give you as an endowment and they say, we don't want you to spend it. You can take the interest from that and spend it, and that's acceptable if they said that you can. Donors can limit what you can do with what they give you. And that's what the term restrictions means. So I have a client that I had them come up with a document for every restricted donation, because there's caveats and rules about how you can spend it. And you want that documented and have it in a place where you can see that very easily. The accountant is going to ask you for it, because when they're doing your 990, when they're doing an audit or an audit review, they need to list those things, show what portion of your income is restricted. Income earned from an endowment in the form of interest does get reported, but with appropriate restrictions. And income that isn't cash, such as donation of goods, can be recorded in the revenue column. In kind is something you can record, but you need to separate it so that it's not listed with cash. There's some complex ins and outs of activity statements for issues such as donation of services, acquiring collection of items for museums, which aren't always classified as revenue. These are rules that I talked about. The CPA knows that you don't have to know, but they know. And they're addressed in the generally accepted accounting principles, GAAP, that we talked about earlier. They're addressed in that, and the accountant knows about it. So that's why he has to ask you lots of questions when he's doing your reports, so that he can document properly and give the proper opinion about, yes, they're spending money that they shouldn't be spending because it's restricted. If they give it to you for a certain purpose, you have to use it for that purpose, or you have to get express permission from them to change what they intended. So keeping the original document, a document for each restricted donation you receive, is a good idea, because you can refer back to it and say, can we spend this? This is my favorite one. It's called Statement of Cash Flows in QuickBooks, but I call it cash flow projections. It changed the way that my organization has functioned, because I am able to see in 3 months, I may not have enough cash to continue to survive. I may not be able to make it to the 4th month. I did not know that from just running these top 2 reports. Income statement might show you we got $100 in and we spent $30. $70 was left over. But that 70 was purchased equipment, which is on the balance sheet. And now you have no dollars to do next month. The cash flow projection will help you with that. QuickBooks may not do that report for you. I do it in Excel, but it's a way for me to see January, February, March, April, May, and I can look at May and say, I may not have funds in May, so I have to now in January know what I need to do to make May work. Now, QuickBooks, like I said, won't give you that information because in the cash flow projection, you get to put in things that you think might happen. I might be able to get a grant for $30,000. So I'm going to put that in, but I'm going to put it in a different color so that I know it's not guaranteed. QuickBooks is more reality. Cash flow projections is kind of like a mini version of your budget, a month to month version of your budget. And I highly recommend this report for line items that are impacting your cash flow because you want to know that you're able to survive from month to month. And it's sad that nonprofits have to be this close to the edge, but sometimes we are. That's the reality of it. It also tells us, oh, we're doing well. We have 50,000 left that I think we're going to take that and put it into an interest-bearing account for 3 months. We tie it up for a couple of months. We can afford to do that because we have enough left besides that to continue and survive. Your cash flow will allow you to document, I have a potential grant that I might get. Now, if you don't think you're going to get it, I wouldn't put it on there. If you're not sure, or this is a first-time funder and they may not give you the grant, I wouldn't put it on there. You want to put things that you're pretty sure might happen. I plan to have this extra coming in. So at the bottom line, the board will be able to see, if you give this report to the board, which I recommend, the board will be able to see, okay, we're going to be able to make it 3 months down the line. Or you're not able to make it and they should be helping you. It's not just your problem. I like to call it the octopus effect. It's everyone reaching out to whoever they can get you to a place of sustainability. So cash flow projections, I highly recommend. It provides a picture of cash coming in and going out in a given period, whether it's a year, a quarter, a month, and it's generated on demand for a determined time period. So it's a fluid document. So when you really want a bookkeeper to help you with it, so that they're putting things that happened on it and you can see what's going to happen. Not that important to go back and fix things in it that didn't happen or happened, because you can do that and see that on your statement of activities. What you're really looking at it for is down the road. It has your income in it, it has your expenses in it, but it has an additional thing, which is your cash balance at the end of the month, down at the bottom, in the way that I do it anyway. So that tells you the cash balance is what you need it to be, because you really want to know that you have 3 to 6 months at least of funds available to take care of your monthly expenses. If your monthly expenses are $50,000 a month, then you need to have 150, if not 300,000 in the bank or in investments or in anything that you can transfer to cash immediately. And this cash flow document will help you with that. To the statement of functional expenses, I went over with you and I showed you what it looked like in the 990 form. But that is something to be thinking about throughout the year. You don't want to wait till the end of the year to say, oh, wow, this looks terrible. I got to fix it. As you're looking at your monthly reports, you might run a report that breaks it down between program administration and fundraising and take a look at what it's saying right now in the bookkeeping, because that bookkeeper should be putting a class to every single expense so that you can see, was that a program expense? Was that an administration expense? Or was that a fundraising expense? They can reclassify things. I went to a meeting, but that wasn't for admin, it was for program. So all the costs associated with it go towards program class. Again, don't wait till the end of the year to start looking at that and making journal entries to fix things that you could be fixing all along. So if you're getting these reports regularly, you're on top of painting the picture the way you need it to be at the end of the year. The budget versus actuals is a way of looking at the same exact document, which is the statement of activities. The only thing is you're going to be comparing it to your budget, to what you thought was going to happen in the beginning of the year. Now, the budget is a frozen document. The board votes on it at the end of the year, and then you're operating from it. And you generally don't go back and redo your budget. You make a budget for the year. It's your projections, and it's different than the cash flow document because this is frozen. It's a budget that you think you're going to be using. It's a budget that you may present to funders. It's really your expenses that you think you're going to spend throughout the year. You can have an income section of it where you're looking at the income, but that's not guaranteed. But what expenses you're planning to spend is pretty much what's going to happen. So it is the profit and loss. It is the income statement. The budget versus actual report is the same exact report, but you're comparing it to your budget that you projected to see how close did we come. we thought we were going to have to pay rent for $12,000, 1,000 a month. But then we decided to rent another property and we ended up paying $3,000 a month for rent. Well, we're not going to go back and change the budget every time we do that. We're just going to maybe have a narrative at the bottom for ourselves that says, this is what happened. We got in another grant and we decided to rent another property. So budget versus actuals is just something to look at to kind of tell you how good you are at budgeting. And also you've presented it to different funders and they're thinking you're going to operate that way. If you're not, you need to know why. And the last one might be that same report, but only including certain things for certain funders. We have a funder that wants workforce development. We might make a budget just for what expenses we have related to that. So you may make a projected expenses for specific grant expenditures to give to a funder. That's not a normal report that you would do every month. The others are. The statement of functional expenses and this last one are not ones that you're going to be doing every month, but the statement of functional expenses you should look at periodically so that you can see how it looks. It's not something I would give to the board. They're not really that concerned with it. And neither is the board concerned with the budget reports for particular funders. But the other 4 reports are reports that the board should be looking at and helping you to make the proper decisions to survive as an organization. So comparisons, I don't give reports unless I'm comparing them to something. Budgets compared to actuals, what really happened versus what we thought might happen. But every other report you can compare from this year to last year. And it is so helpful to be able to look and see this year our budget is $800,000. Last year it was $500,000. Wow, what happened? Well, in this line item, we got this much more income. But you know what? In this line item, we spent a little bit more. So looking at it in comparison really is helpful for the board, for funders sometimes too. They don't necessarily have to have comparisons. They're only asking you for a snapshot of today. But you want to be able to look at that because some things may stand out to you from looking at that. Wow, this doesn't seem right. Maybe the bookkeeper recorded it incorrectly in the wrong account or something like that. So I always recommend comparison reporting so that every report you get, you're looking at it and you're also looking at a variance column that shows you the difference between the two so you don't have to calculate it in your head. So what QuickBooks can do that very quickly for you, where you can see this year's versus last year's and a variance by dollars and a variance by percentage. And I believe that that's a good report to give when you're giving reports to board members because they're able to look at that as well. And they may have last year's report, but why make them go back to put them together to see if they're curious? So comparison reporting is to me standard and necessary. And then we talked about project reports or grant reports. You can have a report for the events. So a lot of us do galas, do fundraising events. We want to know how they did. And you can come up with that report separately, but QuickBooks will do it for you. You're able to put in a class for everything spent for that gala or that fundraising event and run a report. Thought we would make 150,000, but we made 100,000 and we spent 98. Then was that really worth it? So you may want to look at an events report to be able to see whether it was even beneficial to do it. There's other reasons for doing events. Doesn't have to be that we wanted to make money. Definitely, it's the primary reason. But you want to do an event sometimes to build awareness, to bring your board and everyone together, to get funders to come and see what you do and have your kids perform or your testimonies from some of your clients. So there's other reasons for doing events, but the primary purpose usually is fundraising, and it doesn't make sense to do it. It's labor intensive unless you know that you're going to make a certain amount. So you're also doing a projection for that. You should be doing a projection. And then the actuals you can run in QuickBooks to show what really happened. And you can see, we thought we would sell 100 tickets, but we sold 70. Okay. So we didn't make what we thought we were going to make. And there's some really good special event budgets out there that makes you think of everything you might have to spend money for. You have to spend money for sound. You have to spend money for, giveaways at the end of the event. There's all these things to consider. Those of you who you can raise your hand if you've done events, but those of you who've done them know exactly what I'm talking about. I've done jazz concerts, I've done galas, and I've done other events for 25 years. So I know that I try very hard to not lose money, but if you take into consideration the staff time, we probably lost money on a few of them. Okay. So you should be looking at that. or again, you're painting a picture for yourself with your finances that is telling you things. It's telling you whether you should be doing that particular type of event again, or maybe I should be thinking about doing a different type of event because that event really didn't work. There's some people who are stuck in we're doing this gala every year or we're doing this type of event every year. May be necessary to change that. Get some new blood, get a new fundraising person who helps you come up with a different type of idea about what you can do to raise funds. Some things, people liked going 2 years ago that they don't want to go anymore. Sometimes people don't want to go in person anymore. Things you have to take into consideration based on that climate that we talked about. Okay, during COVID, we pivoted and did our events online. And those worked pretty well for online and makes you think, maybe we should always do online because in person is much more costly. But nowadays, people will go back to in-person events. So, all things to consider, all things you can examine from finances and see whether or not you should proceed. So it's really going to help you with your planning, with your strategic planning, looking at your finances and looking at the picture that's been painted for you of what you've done and going back and looking at them today after this class. Now you're going to see different things that maybe you didn't see before. Okay. So the restricted fund reporting is crucial. Looking at the restricted funds section of your finances or getting specific reports on restricted funds. So if you got a grant for workforce development and that's $50,000 that they gave you, you should be able to run a report that shows that you spent 37,000 of it so far. And they're expecting you to spend all of it or give it back. So you want to know that you're projecting that you're going to spend the rest of it in the period of time that they gave you to spend it. So looking at these reports will help you with that. And QuickBooks, again, will allow you to put a class for that particular fund or grant. And then looking at that report will help you to know where you stand with that grant and let you know going forward what you're going to have to do. Okay, so this screen is just a restatement of what we've already talked about, that the accounting information system includes your source documents and the things that you enter. And then you have double entry bookkeeping, which is the ideal scenario, but some people can't afford that. And then you're going to get financial statements or reports from that. And then to the right, you see a profit and loss that's really for a business, not necessarily for a nonprofit. And you can tell that because it says owner's equity at the top instead of saying net assets, which it says for nonprofits. But it's good for you to see the different types of things that they consider cash. There's cash in the bank, but then there's securities and receivables and expenses, prepaid expenses. If you pay something early, that's an asset because you don't owe it yet. And then inventory or equipment, things like that are considered assets. And long-term assets might be investments that you're not planning to take out right away or fixed assets. So if you're looking at your bookkeeping or they give you a report and they have these accounts in them, these are the categories where you would see them. You would see these types of accounts in your balance sheet or your statement of financial position and the total assets and the total current assets and long-term assets. They differentiate between the two because they're more liquid. We talked about liquidity. So that first section is more liquid, and the second section, it would take time for you to get those funds out. And then your liabilities, the same thing in order of the obligations. So the current ones are ones that you have to pay pretty quickly, accounts payable, notes payable, things like that. And then long-term liabilities be things that you might pay that you have more time to pay. And then owner's equity in this case is net assets, which is the difference between your assets and your liabilities. To the left here, I was just wanting to show you 40,000 less the 28,000 is 12,000, and that's what your equity or your net assets is. And then the income for the year, this is an organization that just started. Now, if it was an organization that's been around for a while, they might have more net assets because they have prior years income. So your income less your expenses, though, is also 12,000. And that's going to be your retained earnings section of your net assets. What's for the current year, you will see separately from what's your total for all time. The same document that we we're looking at. Here's another way of looking at the same one. It's just a way for you to see whichever one, speaks to you in terms of, oh, I understand now. And this one is more for nonprofits because it's telling you that net assets breaks down between unrestricted, which means that, you can spend it whatever way you choose to, whatever way you've budgeted, or things that come up, you were able to spend those funds, or ones that they've said you have this amount of time to spend it and you have to spend it for this thing, or ones that they've said you cannot spend it at all. It's an endowment, but you can spend the interest from it. So that's the difference between these three types of accounts. And again, debits equal credits. You're seeing some that are debit type accounts and some that are credit type accounts, and they have to add up and equal. So your statement of activities, so let's say you don't have any individual donors. You're not collecting from people individually. Most nonprofits do, but you don't have that. You may not have this in your income statement. These are pretty standard accounts that people might have in the income section of their statement of activities. And remember, that's current year-to-date financial information. It's for the year or for a period of time, not necessarily for all time. You might have other, in your events section, or you might have a line item for events. And this matches what your chart of accounts looks like. They might be what they call roll-up accounts, where you're breaking down your individuals between individuals or board members, because you might want to see how much the board is contributing. You might have other accounts that roll up into this account. Same thing with corporate. You might have matching gifts as a separate account, but it rolls up into everything that's coming from corporate entities. And then you might have foundation grants, different types, and roll them up into this one account. So this is a summary type report that's going to show you the totals for different categories. QuickBooks is able to give you all of the breakdown of this, so you can do a more detailed report if you need that. So that's the income section of your statement of activities. In the expense section, you might have salaries, you might have rent. If you're a volunteer organization, you may not have salaries. If you don't have a location, you may not have rent. Your cash flow projections and your budget is going to look different than others might. You might all have program expenses, and that could be any kind of things from supplies to whatever you needed to do the job for the program. And then you might have administrative type expenses like office supplies or postage or whatever. So in your expenses, you have different types of accounts. And the best way to see what you're using in yours is to run a chart of accounts. Print it out for yourself. Then you can see, oh, these are the categories that we're using that are going to show up on our income statement. Well, you know what? I want to break down program expenses into professional services and equipment or whatever. You can break yours down, but keep in mind that your chart of accounts in QuickBooks is pretty generic. It's not something that you can just say, I want an account called Mary's donation, because you really want to have it be individual donations, not particular things. You want it to be something that's standard and that you will see it across the board in different agencies have the same type of accounts. Every agency has salaries. They don't make an account called Lydia's salary or Alejandra's salary. They make an account called salaries, and they don't necessarily fill up their chart of accounts with a lot of generic names. And I had a client like that once who just had a whole bunch of different accounts for every program thing they did. Categories and the chart of accounts is one thing, classes is another. And for every expense, you have two things to record. So you're going to put it in the category it is. Salaries is the category or the chart of account, the account from your chart of accounts. And then to the right side in QuickBooks, there's a place for you to put a class associated with it. So let's say it's my salary and I want to put $50 of my $100 towards program. I would put three things, or I want to put some to program, some to administration, some to fundraising. So I would put three classes for every transaction instead of one. But on the chart of account side, it's only going to one account. So there's two sides to record. So then the difference between your income and your expenses is giving you your net income for the year, for the period. We'll go back to the income of $56,468. We see the expenses, and let's see if Lydia did this right up. We didn't change the expenses amount, but in any case, there's a deficit. And whenever you have a deficit, it's not a good thing. You really don't want to give reports to people that show that you have a deficit, because that means you're not really budgeting correctly, or it means that you spent more than you thought that came in, and really that in your personal bank account you couldn't really do that. So you don't, unless you got a loan or overdraft checking or something like that. In your nonprofit, you don't want to do that as well. But there could be reasons for it. For example, you have an expense that happened in January, but you won't get the income until March. So just as long as at year end, there's not a big deficit, you want to make sure that you're not running at a deficit. That, if you've heard that term, that's what that means. The expenses are greater than your income. And if you wanted to look at, over a period, I recommend this as well, because remember I talked about comparison reporting, being able to see at a glance, oh, we went from this to this. We're going up, but wait a minute, we're going back down. What's happening? Oh, it's because this grant was a 1-year grant and it's gone, or whatever the reasoning is. Understanding why you have the picture that you have. This is not something you might give to someone else. This is something you might want to run. And there's lots of ratios and things like that you could run. There's software that help you make graphs and things like that. And sometimes if you have a board that's not financially literate, they're able to understand it a little better with a graph than they are with the financial reports. Even though you have to give them the financial reports, you might want to add a graph or two so that they can see clearly what they're supposed to know. And you can also give them ratios. And there's ratios that you can create that will show we can last for 3 years with the current cash balances that we have, or we can last for 5 minutes. So we need to do something immediately. So there's ratios that you can create, and you can Google ratios and figure out how to do that. But just to be able to show them, based on what we have in the bank right now, how long can we survive? So that's another way of looking at the cash flow projection. Let's talk about the budget. Balance sheet strength demonstrates your financial health and the ability to meet your short-term and long-term obligations, and resilience during economic downturn. Key indicators of strengths include a favorable debt-to-equity ratio, or debt-to-net assets ratio, and positive net assets, not deficit. We don't want to be in a deficit. We want it to be positive. And efficient asset management, that your equipment, and you're depreciating your equipment and rolling it over and constantly having new equipment. You want to identify the money you have coming in for your income. And in the budget section, you really want to look at those different categories and what income do you have coming in those categories. So the budget at the beginning of the year, you're saying, okay, I know that I'm probably going to get this grant again and this grant again, and that we'll probably make about this much from individual donations or whatever. So that's how you're budgeting your income. Or, you might have even some earned income, which means that you're doing something to create funding for yourself. And that earned income, you can project even a little better because it's like a business. So you kind of have a better sense of what you might make from that. But that income number should be all your expenses. You don't want to budget for more than your budget expenses for more than you think you're going to have in income. So your expenses need to be matching your income, or with a slight income increase above that. When you look at your expenses, you're saying, I can spend this because I think I have that coming in. And you're projecting and tracking expenses from the prior year. To create a budget, you can run your actuals for the current year and take a look at it. Did that last year's budget work? Well, maybe we'll use it again. Or we need to change the budget. It didn't really work, and we need to figure out what we're going to do instead. You need to set goals and compare it to last year and create a narrative for changes, because when you discuss it with the board, you might say, we're going to change this category because we feel like we didn't really do that. We're going to do something else instead. But expenses, you have a better sense of, I have these 3 staff I have to pay. That salaries, I'm going to have at least that, maybe more. And then program expenses, we have to spend this much. So you can budget your expenses really well. Sometimes there's things that inevitable that you're not able to change about budgeting, but you want to make sure that you've thought about everything that you can think of when you make that original budget. And the only time you would change a budget that you've made at the beginning of the year is if something really significant happens. And I would say if it's going to change your budget 25% or more, then you probably need to make a new budget for the year. But other than that, you're operating from the budget that you started the year with and that you thought would happen throughout the year. And you're just creating a narrative for why there's any significant changes from that budget. Here's a sample of the cash flow projections that I talked about. What is your opening balance at the beginning of the year? What is your income that has come in July or that you think will come in July? And then your expenses for July, and then the balance. That balance rolls back up to the top of August. And then you see that at the end of August, you didn't have any income. Your balance is less, but it comes back up in September. So looking at it month to month is vital, because to go back or try to figure it out 6 months in advance without being able to look at it like this kind of makes it hard to project. And then you're surprised by things. Cash flow projections to me is vital. You can list in here as many things as you want, or you could roll it up and summarize. I think we're going to get just much in individual donations in August. Or you could say, I'm going to get individual donations from this one, this one, this one, this one, this one. It can be as detailed as you want it to be, because this is a document that you create in Excel for yourself to use and to show the board that you're thinking ahead to what's going to happen. Database management software is something that you should have to track donors and individual donors. If you expect to make anything from individual donations, you should be tracking it in some way and monitoring it. So do you have software to do that? And then is that software talking to your bank? Do you have one that will talk to your bank and to your credit card processing service? You want a software that will work together with other software to help you manage it better. Your QuickBooks definitely should be integrated with your bank accounts, your credit card accounts, maybe even with your payroll service. You want to know, is that happening? Payroll service integrated with your accounting system. And what is your credit card processing service? Do you have a few? Click and Pledge, which people don't normally have heard of, but that one is on our website for people to donate. And then do you know what rate they're charging you? And that varies and it changes. So these are questions that I think a bookkeeper should know answers to. Database management software you use. We've got some Salesforce people out there. It's a little complicated, but it's free to nonprofits. Donor Perfect is not free, but it's very popular. It's one that a lot of people use. Some people don't have one yet. And if you're using Excel, that's fine to get started. But if you're planning to really track individual donations, database management software would be necessary. Is it integrated with your accounting system? So yes, generally when they take donations or take tickets or whatever through those software, they are integrated with your bank or your payroll, your processing service. And then is your QuickBooks integrated with your bank? Yes. And if it's not, you can do that. And it makes the bookkeeper's work much simpler, because it's putting in all the transactions, and all the bookkeeper has to do is categorize it and put in the class. The bookkeeper, then you would have to pay less to if you're paying hourly. Some people use an ADP, some people use Paychecks, QuickBooks, payroll software. Some people use that. I've just heard of one called Gusto. Is it integrated with your accounting system? Does your payroll talk to your accounting system? Some people have their payroll, but they keep it separate. QuickBooks payroll is good. I think it costs a little bit more than ADP and Paychecks, but everything is fine-tuned to what your specific needs are. And what is your credit card processing service? Some people are still using Square. A lot of people with Venmo and Zelle and different things out there now. And some people don't have anything set up. So you kind of want to see what's set up and then see what they're charging you. What is the rate they're going to charge you? Because that may make a difference. There's one of these database management software where they're telling your donors, oh, would you like to donate 15% to help the nonprofit? And really it's going to them instead of you. So you really got to watch with some of these programs. You want to connect to the banking and make it as simple as possible for yourself. Your bookkeeping is simpler when everything is connected and integrated. So you have that ability now that we didn't have way back when.